Copenhagen and to come to CBS to give us your thoughts on what you think about the tax policy. First of all, I also want to reiterate that this is not just a Danish event. This is also an international event. We have people joining from different continents, from Africa, from Latin America, from Europe, from Asia. So this is much more international. And that is what it says about tax policy. Tax is not restricted to one particular geographic, and especially the topic of what Pascal is going to talk about. This will be really, really interesting. So before I start, the goal of the series, which I kept Futures of Tax, is to provide a neutral platform where key thought leaders in tax policy, they come to Copenhagen, they come to CBS, and discuss the things which they want to talk about, but they can't discuss because of various other affiliations or affiliation to government. We wanted to provide a neutral platform. So this is the place where key thought leaders are going to come in the future to talk about what they think about tax policy and what are the key burning issues which are out there. When I kept the name of the series Futures of Tax, this is the event when Pascal accepted our invitation in January. I didn't think about what was the intention. I was just thinking about the future, about the futures of tax. But the world has changed in the 3 weeks. Yeah, it's not 3 months, it's not 3 years, but it's just 3 weeks the world has changed. So the name of the series is now, it's much more relevant than ever before. Yeah, so that's why I say futures of tax. We need to be thinking about futures. Yeah. So why I said that the future has changed. The first is the US withdrawal from the OECD global tax deal. The second is the US exit from the UN tax negotiations. Yeah, people who do not know much about tax, there's also OECD also deals with the tax, and UN also deals with the tax. And there is this tension about who is going to be in charge of the pillar role, and the related consequences of Pillar 1 and Pillar 2, which I'll be discussing later in detail. And the most crucial thing, which we should not forget, because I say futures of tax, is the impact of artificial intelligence. Yeah, I presume many of us in the audience and also online are already using ChatGPT. Yeah, and this technology is going to have a big impact, not just on the technology professional, but also on tax professionals. It's going to change the way you comply with the tax law. It's going to change the way tax administration deals with the taxpayers. Yeah. So with that, I'm going to deal on some of those issues. So I will have 3 rounds of discussion, and I will later on take a few questions from online audience, also from the in-person audience, and then we will have an informal conversation. And you are happy to raise any questions. There is no good and bad questions, so please raise your hands if you think anything you want to highlight. So with that, I just want to start with what has happened in the last 3 weeks, and which is US has walked away from the proposals which had been discussed from the last 15-20 years, whether it's Pillar 2 or in Pillar 1, Pillar Amount B still exists. So if the US walks away, what happens next? So could you offer some assessment about where Pillar 2 now is going in terms of after the US withdrawal?
Thank you, and good morning to you all. Very happy to be here. In my new capacities, professor is exciting, so I can speak freely. I'm no longer a diplomat. I always spoke freely, but now it's unleashed. So very, very happy to exchange with you this morning, and thanks for the very good initiative. I think it's always good to think forward, especially in the world of uncertainty as we now are in. I assume you all know about tax, right? If not, you may want to have a leave and a good coffee somewhere. But
They don't like to pay tax. That's it.
yeah, but if you have any question, if we get, I mean, too technical, I'm not too technical, as everybody knows. But if we get too technical, don't hesitate to object or raise your hand. So the question indeed is, Trump arrives inauguration day. He issues a series of executive orders, and one of the executive orders, a memorandum for the Secretary of Treasury about the OECD, which is in the title of the executive order, so kind of targeted, and say we leave the agreement. And it's Trump's strategy to drop a bomb. It blows out, everybody's deaf, disoriented, and you don't exactly know what's true, what is not true, and it's really part of the strategy. Some who work closely with him say, don't be seduced by the noise. I mean, that may have been true for Trump 1. Trump 2, I don't know now, given what's happening. I mean, Zelensky being a dictator, Russia being the victim in the story, our friend. So you at the end you lose. I mean, you're disoriented, and maybe it's not a strategy. It's really what they're doing. So let's put that aside. On tax, the big surprise was it's on day 1, before trade. It's been 2 years. We all know, we all have known that the US Republicans didn't like Pillar 2, and they didn't like in particular the fact that American businesses in the US, if their effective tax rate in the US would be below 15% effective, which can happen, but the reality of the issue is to be decided, but it can happen, because the nominal rate is 21, federal, you have the states, average, 3-4%, I don't know, depending on where you're located, 25, but you can have massive tax credits, which are not refundable, therefore they reduce your effective tax rate. And if your effective tax rate is below 15%, as you have a significant mass of countries which have implemented the under-tax payment rule. So for those who don't know, tax already lost. But for those companies, if the effective tax rate of which would be below 15% in the US, they will be caught by the under-tax payment rule. In other words, to make it political, the Europeans will put their dirty hands in US profit. Is it acceptable from a Republican perspective? No, it is not. That makes them angry. And that's why a congressman 1 year ago or so tabled a bill to say, if they do that, we will hammer them. And we all thought that when Trump would be back, if he would be back, he is, that this would be an issue. However, I thought, wrongfully so, that this tax war would be diluted into an ocean of trade sanctions. And the big surprise, I was in Davos on that day, the big surprise when we all looked at the executive orders was that tax stood out. That was a surprise. So it attracted a lot of attention, and a few hours later, you had the FT headline saying the US is withdrawing, the Pillar 2 is dead. Now, to respond to your question, is it true? Well, I mean, first, the answer was not really ever part of the deal. So I'm withdrawing from something I'm not part of. Interesting, right? Now, you can nuance and say, well, Biden agreed to the architecture of Pillar 2, and he agreed at a time where he thought he would implement the Pillar 2 in the US. He agreed something which is so unusual with the US, extraterritoriality implemented by other countries to the US. Usually it's the other way around. We, the US, decide what is good for us. We impose it to the rest of the world through extraterritoriality. For once, they agreed something reciprocal and extraterritorial against them. Why? Because Biden thought he would get it through Congress. And he failed by 1 vote. Manchin. Senator Manchin said, we don't want this thing. It will not be in the Inflation Reduction Act. So the US failed to implement the minimum tax. The US is no tax haven. The level of taxation is no small. Interestingly, and we'll go back to that, I suppose, post-US tax reform introduced by Trump, the US has a much broader tax base. So the risk of having American companies undertaxed is small, but still, if you do a lot of R&D, that is the case of pharma, that is the case of the tech companies, that is the case of maybe one or two other sectors, I mean, the big brand names, then you may have the issue, and what the US says by withdrawing from the agreement is we will not allow other countries to implement what the US kind of agreed, which is the UTPR against the US. Now, there is a remaining question I don't have the answer to, which is, what is their war goal? I think talking about war is appropriate now with the US. We're talking about a tax war at this stage. What is the war goal? Is it just to tell the Europeans, the UK, the Canadian, I mean, the 51st state, the Japanese, the Korean, those who have implemented the UTPR? Is it about telling them you don't touch American profits? Or is it about telling them you don't do UTPR? And that has dramatic consequences. The difference is massive. Because if it's just about the US is no tax haven. The US always got a free ride because they're big. I mean, you know, the international environment is about unfairness. You're big, you're stronger, you get a free ride. You're smaller, you follow. It's unfair. And the beauty of international organizations is to try to level the playing field and limit the unfairness. So the US always got some form of free ride. So look at exchange of information. They have FATCA, it's good for them, but they don't reciprocate. Are they listed by anyone? No. Why? Because if you list the US, you're dead. The OECD, you don't want to be dead. Is it fair? No. Is it still good policy? Yes, because if you don't do it, the situation is worse. And the US is not the ultimate tax haven. So if you don't implement the UTPR to US profits, unless the US moves to zero taxation, which I believe they cannot afford, at some point the markets will wake up, we'll see, but they cannot move into that direction. Not fair, but not the end of the world. Now, if the war goal is to say your UTPR, you get rid of it, including on US profit in, let's say, Cayman, because the Cayman Islands have not implemented the minimum tax. They don't have a qualified domestic minimum top-up tax. So if the US says you Europeans, you don't put your dirty hand on pockets of profit in Cayman, which are taxed at zero, and the materiality of the issue can be discussed too there, because they have it. Who introduced the global minimum tax first? It's Trump. You can go back to that on the history. It's very interesting. It's very paradoxical. But they take a bit of it, but as you know, GILTI, which is their global intangible low tax income, their minimum tax, is computed on a global money, which means that you can still have pockets of profit in a zero tax jurisdiction, which will not be caught completely by GILTI. So is the US war goal to say you cannot touch profits of American companies in tax havens to shorten it? And if it is the case, then you have an issue. You have an issue because if it is the case and at the end of the day they get it, the minimum tax is gone, finished, vanished. Because who would keep a domestic minimum top-up tax if the profit is not taxed anywhere? The way we design the minimum tax is the UTPR, the other tax payment profit rule, is a backstop. Some would say, Doug Greenberg, who negotiated the agreement, he calls it the enforcement mechanism. So if you lose the enforcement mechanism, you lose the thing. Now, but that's a big if, or there are two ifs there. The first if it is the war goal of the US, which I don't see, but I mean, I didn't think that Zelensky was a dictator until 2 days ago, so you never know. The second if is, even if it is their war goal, you would need the Europeans to agree by unanimity to change the directive, because the UTPR is in the directive. And getting the Europeans to agree by unanimity, in other words, to knee down to Trump because he's frowning, when you have a few other things which are happening where you may want to flex your muscles and say, hey, sorry. So getting unanimity to change the UTPR applied to pockets of profit at 0% in some jurisdictions or in tax haven, that I don't see. So here, I mean, cutting short this too long answer, is the deal at risk? Maybe. I mean, the world is at risk. So yes, the deal is at risk. However, if we keep the UTPR, there is a minimum tax. Now we're left with the US. We go back. What are the options to kind of safe harbor the US, which don't require a change of directive? I believe it's possible. But to finish it up, contrary to day one of inauguration, day where you had this tax outstanding, now tax is getting diluted in all the trade sanctions which are being taken. So, you know, uncertainty, unpleasantly, it's not nice what's happening, but there is no big surprise. And again, if the war goal is what we think it is, there may be no big drama here, but there are many other dramas in tax on Pillar 1 and many other aspects.
One of the issues which you mentioned is this Pillar 2's enforcement, which also includes IRR and UTPR. One thing is OECD, outside of OECD member countries, only few of the countries who have implemented it, and even some of the countries who are inside the OECD member states, they are seeing different implementation of IRR, UTPR. So one of the quote by Itai Greenberg, he said that OECD's credibility now hinges on whether Pillar 2 succeeds. Yeah. So are we seeing that where countries will be implementing Pillar 2 differently, if there will be a fragmented approach, or is Pillar 2 going to succeed?
We'll see. I mean, I think Pillar 2 is already a success. Pillar 1 is nowhere. I mean, you have an architecture, you have a blueprint. I think that's the blueprint for the international tax of the future. Talk about the future of tax. I strongly believe that there is a need to move towards more destination. We'll go back to that. And again, who started that? The US in 2017 with Trump. But I believe in the move towards destination, which should make me very unpopular in Denmark. Because you have very successful companies. I remember a conversation with your finance minister telling me, I simplify, I have 90% of my corporate income tax coming from companies who do 90%, 90 of their revenue outside of Denmark. And when you talk about destination to such a country, you're not very much welcome. That's why I was glad to have your invitation. It allows you to come back to Denmark. So Pillar 2 is a success to the extent that it's been implemented by a critical mass of countries. And the way Pillar 2 was designed was for it to happen even if some key countries don't implement. Put yourself in the shoes of the negotiators. 2017, the US introduces GILTI, Global Intangible Tax Income, for excess return. You have a minimum tax. Global blending, but strict rules of tax credits, deductibility. So it's a significant change. They didn't remove check the box, but they moved to a broad phase, right? And by the way, in 2017, when I thought I would be fired as a French socialist being the evil and being French meaning socialist. I'm not disclosing my political opinion, but socialist means communist for the US. So you should be dead meat. Trump is elected. I was preparing my boxes. And one day in July 17, I received a phone call from the Senate. Say, okay, that's my death sentence. And they say, you know what, guy, you introduced PEPs. We want to do the same. Can you help? Yeah, interesting. And they implemented the hybrid rules, they implemented the thin cap, action 2, action 4, and they said you didn't go far enough on transfer pricing, so they did the beat. They were very good at acronyms, base erosion, anti-avoidance tax. We beat you to death if you shift too much profit. And then they did guilty. Nice acronym too. So they introduce themselves the minimum tax. And if you're a negotiator, if you're a European, you say, wow, that's great. We want the same tool. There is a new toy. We want this toy in better. And that's where you try to make it better from a high tax country perspective, which is jurisdictional blending. But now, in terms of dynamic of negotiation, you have the inclusive framework on BEPS, you have an open world, you have more than 100 countries at the table, including the low tax jurisdictions. What can you do? You can do a minimum standard. A minimum standard is something, it's not in the Vienna Convention, don't look for it, but it's a new international public law concept. A minimum standard is soft law, which actually has become hard law. Hard law, why? Because of political dynamics. I mean, there is a thesis which could be written on that, because nobody has ever, written on these new concepts. But it became de facto a minimum standard for exchange of information, for action 2, for action 4. You say, if not everyone applies it, implements it, then it doesn't work. So you need to level the playing field. So you find a political dynamic for everybody to apply, to implement, and the political dynamic is to use the G20. 80% of the world economy, if you don't do it, we harm you. And then we do a peer review to check whether you do it or not. And then you have the minimum standard. But for the global minimum tax, it's difficult because to have a minimum standard, you need to have consensus. And you need not only to have consensus to agree on the rule, but you need everybody to apply. And on the minimum tax, clearly, you cannot have the pressure exercise on the low tax jurisdictions for them all, for you to be sure that they will all implement. So you need to design something different. And the something different is a common approach, which is another concept which was introduced during the BEPS plan. The common approach is to say, you have a mechanism, you're not obliged to implement. We recognize that Cayman is not obliged to implement. But if you implement, this is how you need to do it to avoid the fragmentation. And the mechanism was such as it has an impact even if nobody implements. There's this three-tier mechanism. Interlocking rules, the IIR income including rule, the country of residence, cap tax in some countries. The QDMTT, the qualified domestic top-up tax. If you're a low tax country, in between, you can decide to take it yourself. And the under-tax payment rule as the backstop mechanism. And it works only if you have a critical mass of countries. Critical mass of countries doing the IIR, and or critical mass of countries doing the UTPR. The backstop mechanism. And today, to respond to your question, you have success for Pillar 2 because you have a critical mass of countries implementing, both in terms of in-scope companies with the IR and market economies to apply the UTPR. And because of that, you have a critical mass of low-tax countries which have implemented the QDMTT. Why the Q? Precisely to avoid the fragmentation. You need things to be interlocked in the mechanism. So is it a success? Yes, it is. And it started in 2024 with the UTPR starting in 2025. Is it a success? Yes. Is this success at risk today? If the UTPR is undermined, it will be failure. Now, what will the US do? We don't know. Will they send the troops to kill the UTPR? No, they will do that for Greenland or for Panama. Sorry, should not mention Greenland. But that's the scale of things. On the UTPR, they will try to hammer countries bilaterally. I guess they will nicely talk to the Japanese. Say, hey guys, you rely on us vis-à-vis China, UTPR, dead. We'll see. Japan feels very strongly about that because it took 2 years to get the UTPR to Parliament. It may take 2 weeks to get it out of Parliament. You know, but I think they feel strongly about that. Canada, I have a few other issues with Canada, right? You don't know. Well, today Canada is flexing the muscle, clearly, not happy. The liberals who were, losing the election, maybe they're back. So I don't know whether Canada will say we don't do the UTPR. Don't know. The big challenge, the UK is the 51st state in a sense. I will not make friends, I know the UK. But you see what I mean? The dependence is such as, do you go to war because of that? So maybe you can, in a bilateral manner, twist the arms of a few. But the European Union, which is not a power, which is, so disappointing in so many senses, still, they have unanimity for a directive and they will not get unanimity to change the directive. And that's why I believe Pillar 2 will remain a success.
Okay. Pillar 2, according to you, will remain. But the key thing when I talk with the directors of big multinational, whether it's in Denmark here, it's a small country, but so many big companies, it's what does it mean for them in terms of this US not withdrawing? India and China are on the fence. EU does its own implementation. How, as a tax directors of the company, should prepare themselves for the next, how the Pillar 2 develops?
That's a good question. If I'm not the tax director of a large company, I would be very unhappy with Pillar 2, starting with the cost of compliance. You would explain that the cost of compliance is higher than the tax which will result from Pillar 2. And that's not completely untrue. Right? I think the level of complexity is unprecedented. And I could take part of the responsibility. I can explain why we're there. There are reasons for that. But it's an issue. Two, when you're a taxpayer invited to pay more taxes, are you happy? But you're not, especially when you're in high tax countries. And Denmark is probably the country where the CFC was the best in the world. the most efficient. So why doing Pillar 2 when you have an effective CFC? So not a given. So you may not be that happy. Third, and that's, I think, the real question now. The most legitimate. The others are legit, but this one is very important. Is I am at a competitive disadvantage if I do Pillar 2 when others will not do. And we're back to the UTPR. If the UTPR holds, American companies, at least in their pockets of profit outside the US, will be subject to tax. I assume that the US doesn't go further down in taxing its companies. If the US turns into a tax haven, it's a completely different story. Because then you compete with people who are not taxed. But I don't believe the US will move to a tax haven because, as you know, in the US, they don't have VAT. So they rely heavily on direct taxation. And as they rely heavily on direct taxation, cutting direct taxes is costing them a fortune, and they don't have the money. They can print the dollars. I think with what is happening, at some point, they will see the limits. We don't know. We don't know what the world will look like tomorrow, but I will have doubts that the US can cut the corporate income tax further. I don't have any piece of information coming from the US letting me think that that's the plan. So going back to your question, I'm a tax director of a successful Danish company. I'm not happy with the cost of compliance. I should go to the OECD and complain and try to find simplification, decluttering, whatever. Work hard on that. Now, the difficulty, if you're in the OECD, is that everybody comes to you, say, we don't like, it's too complex. That said, I have a special issue. Could you please deal with that? And that's where the complexity in large part comes from. So you have a contradiction there, which is part of establishing norms. When you do norms, you start, I mean, if you rely on technocrats, they will come with something extremely simple, large base, low rent. And then you have all other lobbies. It's not illegitimate, but you will have all the taxpayers saying, hey, come on, I mean, this is different. You shouldn't catch that. Say, no, the policy objective is not to catch that. So you amend, and that's why you get very complex. The other reason for complexity is you try to integrate, and maybe that was a view of the world which is outdated, but you try to integrate 100 plus tax systems. So the transition cost is high in terms of compliance. Once it's established, it's simpler at some point. But it's true, it's too complex. So the first thing I do if I'm a tax director is working on simplification. That's clear. And two, depending on who you are, if you don't like taxes, you go to the government, as some French businesses are doing, and I guess probably here too, and say, get rid of this lunatic thing, which is the minimum tax. We don't need the minimum tax. Look, we're not paying more with Pillar 2, so no materiality of the issue. And I guess a number of companies are thinking along these lines. I think it's short-sighted thinking. It's not very smart, but, you know, kind of the father of Pillar 2, so I'm defending the baby. But I still think it's the wrong approach for two reasons. One is Pillar 2 is not so much about the additional money you will collect. You don't know, it's between 100 and 200 billion euros per year globally. That's not insignificant. But what's really important, if you don't have Pillar 2, which focuses on intangible income, you lose corporate income tax. You cannot stop the trend downwards. That's why, by the way, patent boxes are not validated by the minimum tax. So without Pillar 2, you lose corporate income tax because you don't stop the tax competition. So what Pillar 2 brings is some additional money, maybe less than thought, or this additional money will not go to the places where you thought it would go. It doesn't come to Denmark, it goes to Ireland. Ireland is making money. It doesn't go to France, it goes to Barbados, which is increasing its revenue through the minimum tax. So there is an additional. And when I hear tax directors saying, oh, no, we don't pay much. And when I advise some countries which are low tax countries, and when I see who's operating there, including European countries, I say, well, all these tax directors who never did that, actually they did it. They were lying. I mean, let's be honest. Okay, so the Pillar 2 has a good reason to be there, which is to protect the tax base of corporate income tax. And why is it important for Danish companies? If you stop just being the tax director and you put yourself, just a minute, in the shoes of your CEO, and just a minute or longer if you like it. If you put yourself in the shoes of the CEO, you want a more stable world, in particular in Europe. The deficit in Europe, I mean deficit, I'm not talking about fiscal rule there, but the gap between the current resources of the European Union and what is needed to ensure our defense, because we can no longer rely on Uncle Sam. The gap is 4.5% of the European GDP. In the 4.5%, I includes the cost of the energy transition. You need money. You cannot get rid of corporate income tax. And if you get rid of corporate income tax, it will just be VAT. VAT is already very high in Europe. Only VAT, because if you lose corporate income tax, you lose personal income tax. So if you step out of your day-to-day management of your directorate, which may drive you to say, hey, come on, and Pillar 2, that's a nightmare, let's stop it. I understand that. I would almost have sympathy for that. But if you take the big picture, the impact on the trajectory of corporate income tax, the fact that you don't stop the race to the bottom, and the fact that Europe badly needs money, then I would probably refrain from telling my CEO, go and lobby the government to stop building. I hope I made the case.
I think these are really interesting thoughts and also controversial thoughts. And that's why we like your frankness. With that, I want to open the online as well as offline floor for a few questions. If you have any questions, I will come by. I can take 3 questions from the floor. And if anybody has any questions, is there any questions online?
Sleeping.
Yeah.
The Americans are sleeping.
Yeah, they always sleep. Yeah.
They should wake up now.
Maybe first, maybe I would take from Cecile. Yeah. Could you pass this to Cecile?
Thank you very much for letting me start this small question. Professor Saint-Amans, thank you very much for your intervention. Cécile Brooklyn, I'm chairwoman of the ATLP, and I'm not representing the association right now. I'm just an academic who's trying to understand. The question is quite simple. BEPS introduced for 10 years, 15 years ago, a modified nexus approach for patent boxes. It required states, or not required, let's put it gently, it recommended states to provide a deduction right only to the extent that some research and development expenses were carried out in the territory in question. Now, Pillar 2 goes completely the other way around. It doesn't attach the right to tax to territoriality. From a pure legal viewpoint, for me, this is a trigger of domestic constitutionality issues. You may be aware that regulating tax competition within the EU is not really the way to go in an internal market, and in the EU we have a quite different legal landscape, right? It's quite difficult to get away from these constraints, I would say. And therefore my question to you, what is the mandate of the OECD to change that approach?
Shall I respond one of the ones and take the 3?
Or maybe we'll take maybe I go to you and then to you. Jerome, you can.
All right.
Yeah, just tell your name and affiliation before you start.
Hi, my name is Peter Christensen, and I'm the tax director. You were talking about just you know, I think we generally in the corporate world is okay with having a minimum tax, but as you also said yourself, it is extremely complicated, and it is a huge monster to actually do the compliance. We will, as a company, spend millions on that just to get the right data points. I think it's 200 data points or something like that. So I think we could have avoided that by making some fairly simple safe harbor rules. You know, we do have some safe harbor rules, but they are temporary, as I understand it. You could have made some quite simple safe harbor rules that would have made our lives much easier.
I don't disagree.
So I didn't.
Susie, quickly.
Hi, thank you very much for the interesting points. I'm Susie Barrington. I'm an associate professor in tax law. I'm also a head of tax, guilty as charged. We had a lecture a while back in Vienna by Professor Tracy King from the US. And some of the points she made me reflect a little bit of something you said here, because I was maybe naively, but I was a little bit positive after her lecture, and I thought maybe the world is not going to burn after all. Because maybe not. One of the points she made was that the US suffers from a severe deficit disorder because we have all these initiatives and we have all these discussions about potentially lowering the corporate income tax rate and potentially moving towards some kind of race to the bottom. But I think her point was overall that while Trump is yelling very loudly, he has a few issues when we talk about the taxes, because he has his they have their deficit hawks, making sure that whenever he yells and screams about some kind of initiative to lower the tax and mess up the entire system that you have helped implement, well, he will need not just the support of his own background and his own party, but also the other wings because of the deficit they're facing in the US. So I was wondering, what is your thoughts on that? Is that potentially something that can become a showstopper in their showstopper?
Yeah, I have one short question online, and it says, these are so many complex rules, and in the future, would countries will be able to issue tax rulings without deferring to OECD? So how do the legislative process works?
Thank you for the questions. And I have survived the first round, which I don't know what to start with. Maybe the question on the US, because I think it's a general umbrella. I'm no economist, so I don't know. What I hear, what I gather, what I understand is that Trump comes, he indeed needs to address the first issue from a tax perspective, which is that the Tax Cut and Jobs Act provisions expire in 26. Okay, because to get it passed, you know, in the US, you need to do estimates over 10 years. It's not the right terminology, but basically you need to do the balance of the Joint Committee on Taxation, does the computation over 10 years to see whether it's feasible or not. And after 10 years, when you have big cuts, you cut the cuts, so they disappear. And the cuts introduced by the Tax Cut and Jobs Act benefits the upper middle class, which Trump needs for the midterm election. So they absolutely, it's part of their policy, their ideology, they need to do it. And that costs a fortune. So just extending the tax cuts of the Tax Cut and Jobs Act will be big. How do you fund it? They need to fund it. How do you fund it? I understand the current situation is by firing the federal public, federal civil service. That's it. And that's bold, that's blunt. You could use the word butcher, which starts with a B2, right? So that's what they're doing. And the big question politically is, will the judge one or another stop it? And I think it's for us one of the big questions also on whether the check and balance will work in the US or will they move completely to fascism. So to get back to our tax topics, and tax is everywhere, so including on the big scheme of things, at the end of the day, you need money to fund it. So where do they get the money if you spend that? Well, you can do the balance by cutting a lot. Is there room for maneuver that without unfolding many skills and things? Maybe there is room for maneuver. But can it compensate the tax cuts? I don't think so. So what can be done? Then you print dollars, which has been what the US has been doing for 50 years now. You print dollars. But to print dollars, we're not on the economic field here. We're moving back to politics. You print dollars when you are the superpower. And the big question is, what Trump is doing, is it reinforcing the US as a superpower, or actually, is it undermining it? And that's what the markets will have to call. And I talk about the markets because they are the ones buying the votes. So if you decouple, decoupling was US-China, right? Now decoupling is US-Europe. I mean, in 3 weeks' time, we've been through some deep changes. And I believe it's not just rhetoric. It was rhetoric 8 years ago. Now it's implementation. Yeah, the teams, they do what they need to do, and the Democrats don't care. Very angry with everybody in the US currently. I haven't seen states saying, you do that, we leave. And when you leave the US, it turns into a war. But there is something at stake here which is really worth considering. So what will the markets do? Can you print your dollars as you did to fund your deficit? I don't know, we'll see. We'll see. And what is at stake for Europe is, can Europe turn into a power? We all wish so, I believe. We see it happening, not really. So that's my answer to you, which is, I don't know, we'll see. But my strong belief is, except for extending the tax cuts coming from the Tax Cut and Job Act, can they do much more? No, they can't. And that's why I'm not too worried into the US turning into a tax haven. And that's why I believe that even if you safe harbor the US, you're not putting the European industry at a competitive disadvantage. Is it fair? No, it is not fair. Obviously not. Is it something which allows everybody else to survive? Probably yes. So that's probably the direction. So that was the first question I wanted to respond to. Talking about safe harbor, we're talking about safe harbor, right? So safe harbor may be the way to simplify. Now you need, it's always the dilemma of policymakers. You need to simplify, but you don't want to open loopholes. That's the question. How do you do? And how do you take into account the specificities of industry without making it hundreds of pages of regulation? I believe at some point, from the time I was a regulator, that you need to, I mean, you need some direction to tell the technicians, stop. I mean, when it's bottom up, it's technically perfect, but it may become too complicated. I mean, you bring in Working Party 11, to name it, all the technocrats in charge of making sure that there are proper anti-abuse provision, and you let them handle that. If you don't have a top-down approach to say, hey guys, what is it about? What are we trying to achieve? Can we, you have a read. So it's not easy. Business has a say. Too often, and I provide this as a piece of advice to you, too often business is not genuine enough. We say, oh, we don't do it. You do it. We don't do it. Or so at some point you create lack of trust. It would be better to say, okay, here, I think we were moving into that direction, which is good. Full transparency. Yes, we're doing this, and that you don't like. We agree, let's change it together. And the trust has not yet been completely there. So building the trust further will help find solutions with the top-down approach, I think. On the tax rulings, well, you don't need to go to the OECD, but if you do a tax ruling, you need to inform the partners, which may just be deprived of the taxing rights because of your tax ruling. That's Action 5, which was a direct response to what was happening in Luxembourg. On Tuesday afternoon at 3 p.m., you know that it's this employee of the contribution direct who will issue the ruling, who will stamp whatever you ask for. I have put 1 billion euros of profit in Luxembourg, but actually I believe the right transfer pricing answer was 10 million. Can you confirm your taxing on 10 million? Oh yeah. Yeah, transfer pricing 10 million. Where's the billion? Stolen. Now, if you inform your partners, you stop stealing it. That's why you have automatic exchange of tax rulings. And it works. I believe it's the right thing. No, it's not about, you know, an international organization, illegitimate, with French socialists handling it. I'm no longer there. But, you know, unelected technocrats, which is the US keyword to say kill the OECD. They don't want to kill the OECD, but they want to kill the UN, not the OECD, because if they want to negotiate a safe harbor, permanent safe harbor, they need the OECD to do it through interpretation. That's why they put the pressure, but they don't go through. Last question on patent boxes. So It's the whole story of the past 30 years, which is in 1996 at Lyon for the G7 summit, Bill Clinton, who then wanted to reform healthcare and increase the coverage, needed money, and he could see that corporate income tax revenue was reducing. He said, we need to address that. And that's where the mandate to the OECD to work on harmful tax practices started. I cut short the history to say that the work of harmful tax practices has all been about saying you cannot ring fence, you need to open for everybody. And the outcome of all the work was fiercer tax competition. Ireland did put an end to the Dock of Dublin and reduced the corporate income tax rate to 12.5% nominal and lower effective with all the hybrid stuff and so, right? So you had fiercer tax competition on the one hand, and on the other hand, you had a lot of attention on substance. If you have substance, you're right. And part of the best outcome was to say, with substance, you're right. What was the outcome? I have profit in Bermuda, and there I cannot put much substance. Maybe on insurance, for insurance, but except for that, I cannot put the substance. So what I'm going to do is that instead of the BEPS action plan realigning the profit with the substance, which was the goal, the outcome was in large part to realign the substance with the profit. You see the difference? And people onshored activities, but not back to the US, but in Ireland. Now, on the patent box, you have this idea of making a link with the territory to say you cannot deduct or you cannot benefit from R&D credits. I don't know your R&D credits, but I suppose you have an R&D credit in Denmark. The French have very generous R&D credit. So you do your R&D in the country where you deduct, and you have the tax credit. Effective tax rate negative, especially in the phase of development where you're not yielding revenue. And when you know it's going to work, you shift it to a country which has a patent box. And you're taxed at 4.5%. On Malta, I don't know the rate, but it must be around 4. So the policy objective of Action 5 relating to patent boxes was to say, we want to anchor the profit in the country where the activities generating this profit were developed. And you recognize that within the European Union, because of the freedom of circulation of, you need to do something, thus the 30% of the revised nexus approach. And I already said it's fine, we're good. Some observers then said, Michael Gretz from Colombia, one of the best, said, you know what, Pascal, the outcome of your BEPS action plan is that you have validated these stupid patent boxes. Because it's this race to the bottom of corporate income tax. You just tempt them with some substance requirement, but fundamentally, you allow the UK, the big countries, to do it. So the patent box stuff was not good for the small countries, which cannot really welcome the activities. It was good for the large countries, which could do the tax competition. Not great. Pillar 2 is exactly the opposite. Pillar 2 says all this work on harmful tax practices, on patent boxes and so, which was trying to say, well, you need the substance. We don't care. We do something rough justice, as the Americans would say about guilty. Rough justice is, we don't care. We look at the rate. We don't want to know whether there is active business. The CFCs, we put them aside because they don't work, except maybe in Denmark. We don't care about that. What we care is the effective tax rate. Full stop. And that's why the patent boxes are not, are not having an impact any longer. The only thing which has an impact is a refundable tax credit because it's equivalent to a subsidy.
Really interesting. But we also have 30 minutes left. So you hold on to your questions. We will answer your question later on. But I want to move on to the second round, which is really controversial and really interesting, on which people want to hear your thoughts. One is US has stopped attending UN meetings. UN is developing the new tax convention. Yeah. And this convention has support from the developing countries even my own country, African countries, and many countries who think OECD is not the place where they are best served. And one of the blunt comment of Itai Greenberg, if I could again quote him, he says on the UN's voting structure is a joke. And he says that it is less about real tax cooperation and more about majority politics overriding economic realities. So I want to ask you between the fight which is going on, OECD, who is the best place and who wins is UN tax convention a legitimate alternative to OECD's rulemaking?
Next question. Okay, no, I mean it's a hard one to respond for me. I'm completely independent. I'm not wedded to the OECD. I'm divorced. I mean, not even divorced. It was an amicable curve. So I decided to leave the OECD after 15 years because I was tired, and because I mean it's tiring. Putting an end to bank secrecy, establishing the CRS, doing BEPS, negotiating the two-pillar solution, doing technical assistance for developing countries, building the global forum on transparency, building the inclusive framework on BEPS. 15 years may sound long, it was short with very short deadlines. And so I was tired. I left the OECD. I love the OECD. I think they're doing great work. We do great work, and it happened. So, of course, my luggage is very much pro-OECD. For full disclosure, in 2004, when I was in the French civil service, I was the French delegate to the UN Tax Committee, which had just been upgraded to another committee of experts. And I tried to say, well, why don't we do stuff here? After all, the OECD is good for OECD among themselves. It's not good for the relationship between developing countries and developed countries. And after, so I was the first rapporteur in that group. By the way, I told academics, leave the room, let the negotiators, because everything was held by academics. Nothing against academics. Professor. So it's fine, but it was not the right time. So I tried, even applied at some point to a UN job. And when I applied, they told me what is very important here is the secretary doesn't take any initiative, you take notes. If you want to move things, you need people who are full-time employees of the organization. Because the delegates, they have a day job. So they don't think ahead. The role of the secretary, that's what we did at the OECD, is think ahead. You need always to be ahead of the delegates. Now you need to think what's their interest, what will be the dynamic. And so if you don't do this exercise, you don't move. Because you cannot expect the delegates to think you're paid for that. So if you're paid not to do it, then nobody does. Now, so that's the disclaimer. And I don't need to be politically correct any longer. I'm no longer a diplomat, so I can speak my mind. My mind is one, we have had an issue of integrating the global south in the tax discussion for good and bad reasons, which have resulted in African countries being angry and not satisfied. And that's a mistake of the OECD, and that's a mistake of the European Union. That's the first part. The second part is the UN an alternative to do real stuff? The answer is no. Because the UN functions fully, because of what I've just described, the dynamic of the secretariat. Whoever is there, it's not a question of skills or competence. They are very good people, not the point. The point is the dynamic. One. Two, if you rule by majority in a field where international tax only works if everybody implements it, you make statements. It's fine. You can make statements. The UN is very good at making statements. It's a bit less good at making the world change. So maybe in 1 century from now, because you have had statements constantly repeated, they will become law. Maybe, and in a century time from now. So can the UN change things? The answer is no. They can change the dynamic, they can undermine the existing corporation. They could do good stuff. I'm not so reassured that they will do good stuff. It's all about a political discussion. And the reason for that is, for those of you who have been at the UN in New York City, you can see that it's a place of foreign affairs people. At the G77, you make political statement, all you decide is based on politics. That's fine. But if we're talking about real tax changes to change the dynamic, to put an end to base erosion and profit shifting, to put an end to bank secrecy, to try to build common rules, not the place. Now, you can come up and design a model tax provision to tax services, which is the first protocol we will be working on. But if the Europeans and the Americans are not joining, you can say this is what we would like to do. That's good. Is it good enough to get what you want? No, because the world is about compromise. Either you have your guns like the US and you shoot first and then you talk and then you get what you want. There is a cost for the others still. Or you negotiate, and that's what we did. So to go back to the first point, I mean, you have the different elements. So the answer is, I think the OECD, I personally, but also largely the member countries, they were in a rush to negotiate BEPS, to negotiate the Pillar 2 solution. They didn't have the brain space to say, is it the agenda of developing countries? And it was not the agenda of developing countries. BEPS was not the priority. What's very frustrating, what has frustrated me for years, is that the NGO said BEPS is against the interests of developing countries, which was bullshit. And it was bullshit on purpose to serve the agenda of let's go for the UN, for good and bad reasons. The good reasons is you have naive people thinking it's really legit. It's true, it's really legit, it's really inclusive, but it will not deliver. And when you're a tax justice campaigner, I think it's more important to get things delivered, to put an end to bank secrecy, which benefited the rich and was penalizing the poor, rather than having a debate in an amphitheater where everybody is on an equal footing, where most countries anyway do not have the capacity to participate in the conversation. So this naive / bad faith approach was really infuriating, especially as it planted the seed that it was true, that the OECD was not legit and was not the right place to engage. So that's the mistake of OECD countries, I think, was to be selfish and not to recognize that this was not the priority, and therefore the priorities of developing countries should have been put on the agenda of the inclusive framework. I tried. I even asked the G20 back in 2021 when Italy was chairing to give us a mandate to do a report on what should the agenda be for developing countries. It was ignored by the country, not by the secretary, by the countries. So there is an issue there. It's never too late in their engagement, but not enough. The second big mistake was the European Union blacklisting countries if they didn't commit to good governance, including BEPS. I remember one day receiving a phone call from the finance minister of Namibia saying, how do I become a member of the BEPS inclusive framework? I said, do you want to become a member? I mean, Namibia, there is no risk. It's not your agenda. We didn't do it for you. I mean, you're welcome. Of course, if you want to do an anti-hybrid legislation, we'll help you. But frankly speaking, you may have a couple of other issues to address first. Say, yeah, but if I don't come, I'm blacklisted by the European Union. Big mistake. They did take randomly a number of countries, tell them you don't join. So the countries, many African countries, which thought this agenda is not ours. This house is not ours. And that's, I think it's very important. In the UN, they feel at home, which is true. At the OECD, not exactly. You may be told you're on an equal footing. You don't feel at home. This belonging feeling is extremely important. And when you're obliged to go to this place, which is not your home, because you're blacklisted, whether it's the OECD, the EU, all the EU members almost are members of the OECD, I mean, you don't like it and you're agitated. And finally, seeing the US always getting a free pass, a free ride, it says, well, these people are not principled. So you can say the UN will be better. The UN will not be better. The UN will make statements. So I believe the UN could do better if they agreed consensus. A few weeks ago, they didn't agree consensus in the rulemaking. The other big contentious thing was duplication, not duplication. So we don't care about duplication. We may duplicate. And the paradox there, you said the US left. I mean, the US being at the table doesn't make any difference because they never really engaged in the UN. So I think this doesn't make any difference. The real question is the Africa-Europe relationship, with at CARICOM and maybe Latin America, but I mean, you have a gap today, you have lack of confidence, you have some acrimonies, and they should be addressed, especially in the new world. So that's my response. You know, no, the UN will not deliver the rules which can help developing countries. The last remark, mitigate these comments, is international tax, as much as I love it, will not solve the issue of domestic resource mobilization, which is required to reach the sustainable development goals. There are a lot of lies there, also coming from NGOs saying, oh, transfer pricing, you fix transfer pricing through a rule which will never be agreed, and then you can build more hospitals in Africa. No, that's true. You must fix transfer pricing. Let's get it right. But this is not what will fix the gap. The African tax to GDP ratio is around what, 15, 16%. If you want to fund your development, we don't know what the rate is, but it's probably at least 20%. They have a 4 or 5% gap. How will it be bridged? Domestic taxation. Again, you need to fix international still, but the gap is domestic. And the other thing which infuriates me on that front is many African countries which have been told, oh, Pillar 2, 15% not good enough. ICRICT, you know ICRICT, the International Commission for the Reform of International Corporate Tax, Stiglitz, Dickman, and others. Very well-intended people. Pillar 2 useless, 15% not good enough. And it's for the rich countries. Now, I'm an African country, I have mining. To attract mining, I do exemptions. These exemptions are gone. They will be taken over by Canada or by Australia or by the headquarters of these mines. But because I was told, this is for the rich, this is not your agenda, it's not good enough, I don't do a QDMTD. I will lose billions. And I think there is a responsibility for the people who say not good enough and so. Now they realize that the US is trying to kill it, or after it was not so bad. So I think what the UN could very usefully do, instead of having the debate on is the Armstrong principle good, bad, blah, blah, is refocus on domestic resource mobilization. The Financing for Development Conference at the end of June, early July, which happens every 10 years, is extremely important. And I hope that countries will put efforts to lift up tax administration, to strengthen tax administrations, and to do better tax policies. And also fix the international tax, but you see it's maybe not so important.
I think there are people from ATAP in the online audience. They will listen to your advice and they will follow it. Yeah, before
By the way, ATAP is doing a fantastic job precisely in terms of doing the domestic resource mobilization in Africa. So Logan Bird, who has been the executive secretary of ATAP, and his team have done a fantastic job. And they're very active at the UN, which is fine. It's just that set the expectation at the right level.
Yeah. We have a shortage of time, so before I quickly go ahead to the next round, I want to quickly take a few questions from you. Maybe if I could come to you.
Yeah, I'm Uwe Hindel from PwC. Now you talked a lot about US and Pillar 2, but what about China and India? They seems to be very reluctant now to Pillar 2. And when now India, Russia, oh sorry, US and that's a good idea. Also Russia, they are not part of Pillar 2. Then most of the world is not part of Pillar 2. And can you elaborate a little bit about that? What should be the consequence for you on that? Even one of those tax people which has been mostly aggressive in this, Ivan Orland here in Denmark, says Pillar 2 is dead. But yeah, you have already said something about it, but what in this perspective?
Can you tell your name and affiliation?
He said.
Oh, he said, okay. Any more questions?
So I repeat myself. As long as you have a critical mass of countries and you have it at least with the European Union, but the fact that China, India, and the US don't implement doesn't change anything. And when you say now China is reluctant, delete the now. China has said upfront they would never implement Pillar 2, so there is no change there. We knew upfront that China didn't like Pillar 2. They said it. I mean, there is even in the Pillar 2 agreement and in the rules, a provision, which is not a Chinese provision, but which was negotiated with China in the last week before the deal on the 8th of October 21, which is about companies in the early stage of their development. Because in China, you have many tax exemptions to turn manufactured China into innovation lab China. So the Chinese said, okay, we don't like Pillar 2, will not implement. We don't prevent you from implementing, including on our companies, but not when they are the early stage of development. So there is nothing new there. Now, India, I mean, India not implementing. You have how many in-scope companies in India? Not so many. You have 2 or 3 big ones, including on Pillar 1, which are in scope of Pillar 1. But India doesn't make that much of a difference. It's a very large market, but doesn't make a big difference. So I stick to my answer. I mean, you can say, oh, look, the US, China, yeah, but it was precisely designed with that in mind. So it doesn't change much there. Now, Ivar was a great delegate to the OECD. He tried to convince all the delegates that the CFC in Denmark was the right one. And Action 3, I think, of the BEPS action plan recognizes that. Ivar has the world record with me of the shortest tax treaty negotiation. I think we held 5 minutes when I was the French competent authority negotiating the tax treaty with Denmark on the pensions. Arrived, he says, what can you offer me, Pascal? Said nothing. Okay, terminated. The negotiation and the treaty. And then we had a nice lunch at which was good. But I would respectfully disagree with Ivar. Pillar 2 is dead. No, not at all. It may be dead in a few months if Europe gives up the UTPR. That's clear. But it's a US-Europe conversation. China, I think, doesn't have much of an impact there. India less so.
Any more questions? So we have last 10 minutes. And before I go to the last round, yeah, I also want to talk about more about the younger people, younger generation, and what they can take, what the future is for. And one of the future realities.
Go to Mars.
Go to Mars, yeah, or some things which I should not mention. Yeah. The reality is the rise of artificial intelligence. Yeah, it's just been 2 years since the ChatGPT came, and this has been changing the way we work, we interact, write emails, do analysis. One thing is, this is really going to have an impact. This is like the industrial revolution. After the industrial revolution, this is a new thing. And how it is going to change the tax administration and what tax administration can do to utilize this technology efficiently and positively. And second, the question I want to ask is, maybe not for the maybe for the young people who are just trying to enter into tax profession or already into tax profession, we're not going to retire. So will tax advisors need to evolve in the future as an AI specialist, not just focusing on tax, but they also need to know how to deal with the data, how to do the prompting. So what do you make sense about this technology?
Should ask TaxGPT rather than ChatGPT right now to respond to you. So I mean, I don't know. The honest answer is fundamentally I don't know. I worked on that. I don't use ChatGPT. So I don't know. What I think I understand and I know is that tax administrations started a journey towards what at the OECD we call tax administration 3.0. You may have seen that. So you had the paper-based administration a long time ago. It moved to an administration where you more IT, you're more virtual, and where you pre-file. You're now moving to administration 3.0, where the data is collected in such a manner that everything can be done through data, and you can gain a lot of productivity there. You can improve the experience, the compliance quite dramatically, and you can upgrade the functions of the people, right? And I believe, but that's really an uninformed opinion there, but I believe that AI is not necessarily a change of nature, it's a change of degree. It will enable this move to the administration 3.0 with many functions done automatically. That's already the case. And interestingly, one of the most advanced tax administration in the world was, probably still is, I haven't checked recently for obvious reason, but the Russian tax administration. I mean, the Russian tax administration had developed a number of apps which were able to collect the information online and to deal with this with artificial intelligence, and so to ensure the compliance. Now, the issue with that will be about Big Brother is watching you. So how do you separate out the efficiency with the data protection? But when I say that, I'm always struck by the fact that I gave all my data to Mark Zuckerberg without any control, without any regulation. But when you try to regulate, they point guns at you. So what's the dynamic? Where do you draw the line there? I don't know. And at the time of rising fascism, I don't know. Unfortunately, I mean, I never thought that in my life I would say at the time of rising fascism. But this is what's happening in Europe. This is what's happening in the US. This is what's happening in the rest of the world. So the artificial intelligence, yes, absolutely, it will be key, in particular for leapfrogging in African countries or developing countries. That's obvious. You can achieve a lot, and there should be massive investment there. I mentioned the domestic resource mobilization agenda. I believe that if you direct the aid, or what is left of the aid, to tax administrations, so that they can do this transition, you can really move towards better, stronger tax collection, which may bridge the gap, which needs to be bridged. Everybody has a cell phone, including in Africa. You can use that. You have the information. So I believe countries need the taxes. And the more you do domestic resource mobilization, the more accountable the governments get. When you spend foreign aid, you don't have the same level of accountability as when you spend people's money collected through taxes. So AI, I think it's a no-brainer in terms of, yes, there is a lot of potential. Is it a completely new revolution? I don't think so. Is it a way to enhance significantly the changes which were at play? The answer is yes. what is left for the humans? Well, the high quality stuff. So you upgrade the human intervention. I mean, first to check that ChatGPT stops inventing authors which don't exist in the quotes, right? So you make sure the consistency is there, but you focus on the high quality stuff. So I think it's a no-brainer. I don't see it as a complete revolution, but I see this area as extremely important. The tax administrations recognize it and are working on that.
Yeah. I come to an end, but before I go there, I want to see if there are any questions there in the audience or something people want to know about other than Pillar 2, because everybody is asking Pillar 2. Are there any questions left? Maybe just one question from me, not on the Pillar 2, but on the Pillar 1. Of course, Pillar 1, we still have amount B, yeah, which still exists, yeah. So what does it mean? So when this amount B is still existing and the US has withdrawn from the discussions?
Well, the US has not withdrawn from, I mean, interestingly, when you read the executive order, what you can see is, so don't do the UTPR, don't do DSTs. And if you do these, you have issues with us. Trade sanctions, maybe Section 891, right, where we double the tax rate on your nationals in the US. But they don't say anything about withdrawing from the OECD, because they are not, because they need to negotiate at the OECD, I believe. That's the right thing to do. And two, they don't say that they withdraw from Pillar 1. And again, who started the negotiation on Pillar 1? It's the US Republicans. It was another world, it was another time, and these were largely other Republicans, but they started it. I mean, I remember the meeting of the Bureau of the Committee on Fiscal Affairs steering group of the Inclusive Framework precisely on the 10th of October 2017, where the French say, we want to tax Google, usual. And the American delegate, Chip Harter, says, I think you're right. And the Chinese delegate think that he had interpretations, he was checking the interpretation. What happened there? The US thought of introducing the DBCFT, the destination-based cash filters, to move to destination. Why? Because the US has a trade deficit. You can fix the trade deficit with tariffs or not, or you can draw from that the fact that if you anchor corporate income tax on consumption, when you don't have VAT, you can increase your revenue. And that made the US amenable to the idea that taxing at the market was a good idea. Where the French were disingenuous, so where the Danes was to say, I want to tax Google, but I don't want the Chinese to tax my own companies, because it's specific to the digital economy, not really. The only specificity is about the nexus, I think. The allocation of profit, it's the same on intangible profit, whether tech, whether pharma, whether brands, whatever. And if you think that the current allocation of taxing rights through the transfer pricing rules is no longer fit for purpose, then you need to change it for everyone and not only for the tech companies. So the US started that conversation. It will be interesting to see whether they continue it. And if I were an American business, I would start being a bit worried that countries may react to the US and not just knee down and say, oh yeah, you're right. So they may retaliate on trade and they may move to DSTs if the US were to say, I withdraw. So let's see what happens. I don't know. But we all know that Pillar 1, if not dead, is kind of a zombie. I knew it when we negotiated it. The idea is that nobody wants to declare it dead, because the day you declare it dead, you open the war, and you open the war on something which may not justify your war. And DSTs are not great tax policies, bad tax policies from an economic perspective. And you pretend it's Google which pays, but it's not. It's your people who pay. So everybody here is like, you know, hold me, otherwise I want to fight. Hold me, please. I don't want to fight. So Pillar 1 is an excuse not to go there. So we'll see what happens. I don't know. But as I said at the beginning, the blueprint, which is a move towards destination, is probably a blueprint of what at some point, when there will be an opportunity to go back to the drawing board and do a real negotiation on tax. It's not now, it's not in the coming years, but that will be the blueprint for the future of international taxation.
Yeah, we have come to an end. Before I give the last word to Pascal, I want to thank you all for joining, and also we have exciting speaker next time. So do tune in, and next time do join in. Next time we are going to have Mette Jacobsen, who is the tax head of Maersk. She will be joining here, and so please also next time you could have an interesting conversation. And after that, I will not inform you who is there, but we will have someone from a chip maker who is powering all the artificial intelligence startups. So just think about it, that we will have a tax head of that. But more than that, what we want here at CBS Law, CBS Tax, is come out with the suggestion as to the speakers or key thought leaders which you want us to bring here in this neutral forum, where you want to discuss the topics or the issues which you think as a tax directors, as a government official, or as a student who is or as a newcomer who is just starting his tax career. Yeah, give us the name. You can reach out. You can find my name. You can find Peter's name, Jerome's name, all the people, or Yane's name. Just email us. We will. Or also any suggestions which we can improve next time. Yeah. Any positive suggestions. Don't tell us what we did wrong. Just tell us what. So give us any suggestions what we can improve next time. And also, but more than that, I also want to, one thing I want to acknowledge it. This is not just an event where I was part, as having discussion with Pascal. There were many people also who were involved. I also want them to acknowledge. Linnea, can you stand up? Linnea did our online recording. Imran, stand up. Imran did our video. Camila Brown is our administrative lady who is not here, and Dipti who did the designer. And one more, I had my project, Christina Lubinski. She was also a key person who was backing this project. So without all those people, this would not have been possible. So please give them a round of applause. So the thing is, the name of the series is Futures of Tax. But what we all discussed with Pascal is the futures of tax is uncertain. Yeah, we don't know what is going to happen. So I have one final remark for Pascal, maybe for all of us to take away. What is the biggest tax challenge, or you as in the future think about, whether it's companies, whether it's professional, or whether it's a new students or a tax advisors who are just joining the career, should prepare for in the next 10, 15, or 5 years?
Yeah, there are many. I mean, the first one from an international perspective is, will tax cooperation hold to this collapse of multilateralism? The tax system started a century ago with the League of Nations, very limited international tax. The past 15 years have been a complete renovation of this system with a new type of rules, which is interconnecting sovereignties without tax treaties, hybridity, and so that's a new way of doing international tax. I take into account what's happening across the border to design my own taxation. You interconnect tax systems, and that came together with tax cooperation. And I could say all that the peak of this multilateralism and cooperation was the Chinese summit in Hangzhou in 2016 for the G20 presidency. Everybody loved each other, we're one world, and we work together. You can see that this has been unfolding, but tax cooperation remains. Will tax cooperation remain? I don't know. That's the first one. The second one, very quickly, is you have a gap. You need to finance the energy transition. Believe it or not, there is climate change. Believe it or not, talking to the Americans, the earth is not flat. So you will need to fund it. And that takes innovative financing and so I'm an expert at the Global Solidarity Levy Task Force. You need to help these countries, the seeds, and so to face that by solidarity. What will happen, I don't know. Finally, we can see a plutocracy taking over in the US. The level of inequalities, I think, explains paradoxically the rise of fascism. You need to reduce inequalities. I'm talking in a country which is convinced, more than convinced. You may even have to high taxes. But taxing the ultra high net worth individuals without harming growth is a challenge. There are some proposals and so, but I believe it's one of the things. And finally, to make the link with the next person who will comment this series, and Maersk is a fantastic company doing, being very smart and innovative there. But the taxation of CO2 is coming in Europe. And the shipping industry is an interesting candidate for that. But you will have this issue of environment taxation with finally bridging the gaps in developing countries' domestic resource mobilization. So being in tax policy remains extremely interesting, even though the world is worried.
Thank you so much, Pascal. These are really insightful comments. I want to give the final word to Peter.
Well, I promised you we would finish at 11 o'clock, so we can conclude that I did not deliver. However, what is more important is that I do think that Pascal and Sid definitely delivered a great conversation. Thank you also for the fantastic questions and for being here. So my last task to do now is to hand you a little present. Very important. Here you go, a little Danish delicacy.
Thank you.
And that's it. Thank you very much.
Thank you so much.